investing should be long term. You are not going to get rich from investing. You don't create wealth from investing. You build wealth, meaning that you grow what you already have. So
Exactly.
don't pay attention to short-term results. They are, after all, short terms. And just one thing I wanted to add too is that investing is a road towards financial freedom, and it's not about a game toward. It's not about anything else really. You should be worried about you reaching that freedom, whatever you define it to be. Welcome to the Adapt or Die podcast. This podcast explores ideas related to self-growth, finding meaning, and living a more fulfilled lifestyle. It's your host with the most, Armel Tala.
And it's your host on the low, Ben Smith. We're two college students on our own path of lifelong learning with the hope that you will join us in our journey. And now, it's time for the next episode of
the Adapt or Die podcast. Welcome back to another episode of the AOD podcast. Slow intro.
Slow-mo intro.
Slow-mo. It's because we recorded 2 episodes, 1 hour long episodes last night.
So 2 hours total.
I didn't go to sleep till 2. I got sufficient sleep. Yeah, I don't know. I was just up.
I went to bed at like 11:30 or 12.
Ben over here, a nerd.
Try my best, I actually need some glasses now. I'm almost there. I'm so close.
But still on the topic, I guess, of finance. I don't know. Because last episodes, no, we actually did Benjamin Franklin before this. My mind is completely messed up.
But we recorded it before the episode. Yeah.
Yeah. It doesn't matter. You guys would have listened to Bitcoin series, then Benjamin Franklin, then this. But we had just recorded the Bitcoin before this. So in the way you're hearing and the way it was recorded are kind of backwards, but that doesn't matter today because we're on the topic of
behavioral investing.
I was going to say wealth because that just sounds cooler, but same thing.
Anyways. Before we go on though, I think it's around New Year's.
It's
either Christmas or New Year's or around there. Happy holidays again, guys.
Hope
you're enjoying the break. But anyways, back to what we're talking about today.
So today's book is The Laws of Wealth by Daniel Crosby. This is a book that I came across. Naturally, I've seen this book a good amount of times just because the name is very enticing, right? You see that you're like, ooh, especially if you're young and you're like, I'm trying to make money. And you just hear the laws of wealth, right? It sticks out at you, right? But I think what makes this book more interesting is the behavioral investing, because once you start getting into investing, you learn that, to be honest, for the average investor, it's not complicated in what you should do, but it's actually doing what you should do that becomes hard. It's kind
of like it's not, you should exercise, but the hard part isn't knowing what exercise is. The hard part is exercising. So
yeah,
it's kind of like that.
And so in this book, he lays out the rules, 10 commandments, as he likes to say. And then he lays out, I guess, a framework and ideas of how to actually, execute those behaviors. And so we're going to split this book up into 2 parts. As of right now, we're just going to discuss the laws themselves. And the next episode, we'll discuss more. But Ben, start us off into what makes the world of investing so weird.
Yeah. So the first thing that he touches on is that, there's 2 points he makes in the first, the introduction, I guess, is the first is that you must invest in risky assets or risk assets to survive, but you are psychologically ill-equipped to invest in risk assets.
Isn't that a bit of a paradox?
That is a paradox.
That's weird.
It is weird. But it makes sense when you think about it, just because, regardless of your religion or beliefs, I guess he makes the point that we're not evolved to kind of deal with the stock market and deal with money and currency and all these things. Whether you believe that or not, it's up to you. I'm not trying to. But the point is that we're not really equipped to understand the stock market like this.
Why is that even something to be controversial? I don't know why you said it like that, because it doesn't matter what your belief is. We are not equipped for risk. I guess this is my perspective, but from evolutionary standpoint, we want to be risk adverse to survive, right?
Well, if many religious people don't believe in evolution, so it's
oh, that's what you're referring to. I was just talking about why we aren't.
Oh no, sorry, I'm overly aware of religion for some reason. I don't know why.
It is.
Just disregard if that meant nothing to you. So, or everything. I don't know.
But so when it comes to being psychologically ill-equipped, could you explain some of the reasons why he presented in the book, the
Yeah,
Dr. Crosby?
there are three interesting things that he mentions. The first is that in the world of the stock market, the future is more certain than the present. And when you hear that, you're kind of like,
Yeah, I just even I heard it. I read the book, and even when you said, I was like, wait, what? Say that again.
yeah. So in the stock market, short term the short term is very volatile. You have no idea what's going to happen from a day to day basis, but you can count on um, the averages of all of many stocks, or the averages over a long term being fairly certain, I guess. So it's much more certain over 10, like you'll be able to project growth over 10 years much more accurately, or much closer to the actual growth than you would be, within for the next 10 days. And so that's what he means by the future is more certain than the present.
And this isn't intuitive to humans because we are very comfortable with more. We can predict, like, I know what I'm going to do in the next 10 minutes, means keep talking this podcast, what I'm going to do the next day. But it's very hard for people to know what they're going to do in the next 10 years. So just this idea, number one, is already very unintuitive to us. Number two,
The second thing is do less than you think you should. Oftentimes, when we're meddling with the stock market and trying to pick the best stocks and always, selling and buying and doing all this stuff, we're actually just hurting our portfolio way more than we're actually helping it. And that's just because most of us don't know how to use the stock market, or have bad behavioral tendencies when we're buying and selling due to our emotions. We'll go over more of this later, but just know that doing less is often more in the world of investing.
and this being unintuitive again, just because we normally think that the amount of work we do directly correlates to how successful we are, which gets flipped around in the world of what he calls the Wall Street, what does he say? The Wall Street bizarro world.
Yeah, he's just like a weird.
The
He
way he
has,
references Wall Street is
it's kind of
funny.
funny.
But I also do want to add really quick that not just you as us as retail normal investors, but even the greatest investors that do less, like Warren Buffett, he doesn't. I think he said like he's never sold anything he's bought. He doesn't buy a lot. He's not day trading. He's doing less work, but he's recognized one of the best investors. But continue.
And then the last thing is what he says. He phrases it as far from the madding crowd, but basically the idea is that a lot of times we take the wisdom of the crowd to be very accurate. On things like Yelp. We go to a restaurant, we see Yelp reviews, and we're like, oh yeah, like this restaurant must be pretty good because everyone who went to the restaurant thought it was really really good.
Mhm.
So in the same vein, if everyone thinks that this stock is the best stock, like it must be the best stock because everyone thinks it's the best stock. But he mentions a few things that make choosing stocks much more difficult than choosing things like food, because of those four reasons. Um, in investing, we see the benefits, but not the costs later. Did I say that right?
We see the benefits. We see the benefits not, but the cost later. So I'm thinking he's saying here that
Yeah, we see the consequences of our decisions much later. As that when you're eating food, you know immediately whether the food tastes good, right? For stocks, though, you don't know how good a stock pick is until 10 years down the road. And so it makes it very difficult to understand if it's a good or a bad stock pick. The
mhm.
second thing is that decisions are made infrequently. So if you can eat food every day and you kind of get feedback much more quickly than you would as with like a stock, you pick a stock and you kind of usually just let it sit. And so you're not getting as much feedback because you're making infrequent decisions. The third thing is that the feedback, as we said, is not immediate. So because the feedback isn't immediate, you don't get that information to decide again. And then the last thing is that the language is not clear. A lot of times in the stock market, we have a lot of jargon and technical models and all this stuff that many of us don't even understand. Whereas with things that are much more simple, like food, we all understand good, delicious, bad. So getting information from others, the wisdom of the crowd does not hold in the stock market. I
And
think.
those are all really like those paradoxes are very interesting because really screaming you should not be investing. Like it's telling us like, well, why would I even invest? But again, going back to just the idea is that you have to invest in order to survive because inflation is going to eat all your money. If you listen to our Bitcoin series, you understand a bit why inflation is bad. But so with all that being said, he lays out 10 rules, I guess, to help us, I guess, maneuver in this crazy, bizarre world of Wall Street and finance. Can you start us off with rule number one or
Well,
like as he likes to say, commandment number
commandment
one.
number one. So, rule number one is that you control what matters most. And a lot of times, what he means by this is that we often chalk up stock market investing to being an intelligence game, but really it's an emotional intelligence game. And that the people who do the best in the stock market aren't the people who are the most intelligent, but the people who can control their emotions the best. And that's because you have a lot of money in the stock market. So, when you're riding the highs of the stock market or trying to weather the lows, you have a tendency to make the absolute wrong decisions because of your emotions rather than sticking to a rule based approach. And so his point here was that if you can control your emotions, which is very difficult, then you can be an upper echelon investor. And the way you do this is through rules based investing. And we'll touch more on this later. But the crucial point here, I'm going to say it one more time, you control what matters most, which is your emotions. That is the key thing in investing. And I think Warren Buffett backs this up pretty heavy too.
And what are the? I think at the end of each chapter, end of each rule, he gives us a think, ask, and do. What were those for rule number one?
For rule number one, think what the market does, my own choices matter most. Ask, rather than chasing returns, is there more I could be doing with respect to saving, cutting costs, and remaining patient? Do, automate a process of long-term regular contributions to your investment account that escalate with salary raises.
Rule number one, very straight and simple.
Very straightforward.
So now with rule number two.
Yeah, what's rule number two?
So what he says is you can't do this alone, right? And when it comes to emotions, one of the things that they like to tell us is it's good to be able to express those emotions and talk to somebody else. And this idea kind of applies to investing where you're going to go through a lot of emotional up and down, which will make you act irrational. Emotion when it comes to investing, this is you want to make clear decisions and have systems that we'll talk about, but you want to keep your emotions in check. And the best way he says is you should get a financial advisor. And he says a financial advisor pays dividends in two ways: in your bank account and in your time. So one of the reasons why he says in your time is the stock market, understanding the stock market is like a full-time job.
It really is.
I think it's hilarious when I talk to people that think they already understand and they're my age, because like I feel like I'm pretty not knowledgeable for my age, decently knowledgeable because I just watch a bunch of videos and all that, but I don't even think I'm close to being good at all. Like I literally tell people just buy the S&P. I just buy the S&P and I just worry about trying to build businesses. Like that's about it, right? So understanding the stock market, understanding how it works, there's so many variables and factors. It's a full-time job, so you should hire somebody that will do that as their full-time job, right?
Right.
But the main benefit of getting a financial advisor is actually not for their stock picks and how they're going to decide to how they're going to tell you to allocate your money. The benefit of it is behavioral. Again, having that someone to talk to, like, hey, I should sell Tesla stock. They probably look at you and say, depending on your advisor, they might say, hey, that's a really bad idea. You should not sell Tesla stock. Think about the upside that you told me about and that you laid out this system, this idea, your thesis on Tesla. Or they might say it's a good idea. Tesla's really high right now. It might crash, whatever, right? And so having someone else to bounce those ideas to, and to number one, just kind of help tell you when you're being irrational is going to be really beneficial. And so other benefits, again, asset allocations, withdrawal, tax efficiency is something that is actually really, really important here, because taxes will eat away at your returns on when it comes to investing. And so again, just more important things to know: investing is very emotional. You can get very emotional. It's good to have an advisor that's really there to help you with your behavioral side of investing. And really that's about it I have. So when it comes to, you have something?
I was going to ask you, because I know you mentioned, do you wholly agree with this idea that does that strike you as like the best? I know it kind of hit me. I was like, really, that's interesting. I mean, I'm 19, so I don't really know.
Yeah.
Not like experienced in the world of finance. But how did that make you feel at rule number two? I was kind of.
I've heard a lot of different things. So when it comes to just, I guess, the financial advisor, this idea, I was kind of like reading it with a grain of salt, because I believe personally, again, very novice here, but I believe personally that you should want to take on that full responsibility. Like paying for a financial advisor, I don't think will be as great of a return if you yourself are like competent enough to know, like, hey, there's very simple things I need to do. I just need to do this and make sure that I don't behave opposing to what my rules were, right? But he brings, like he said, him bringing the argument that it is mainly for the behavioral aspect. I'm like, okay, so it's like, do you? It's really based on the person themselves. Like, do you believe you have enough control to not do those things? Then like, don't spend the money on a financial advisor if you know yourself that you can control your emotions, behave, and not look at it. But for someone that may be very emotional or whatever, it might be beneficial there. But I think it's really highlighting the point that you should not be trying to get a financial advisor because you think they will just pick stocks that will instantly turn you rich. No, it's just for the behavioral side. So I don't fully agree with this. I think that you are better off just kind of learning to train your emotions and learning to control your behavior than you are to pay and lose a bit of the fees you have to do there. But again, it's different for people. But so when it comes to like the applications and the think, ask, do, he just says an advisor who keeps me from making the big five mistakes over a lifetime has more than earned her money, which can be true.
Fair point.
What you should ask yourself is if an advisor's primary value is coaching my behavior, what might I look for in a potential advisor relationship? And then what you should do, enlist the help of an advisor or who sees the enlist the help of an advisor who sees behavioral coaching as one of her primary responsibilities, again, because that is the most benefit you will get from them. But I want to ask you a question though. Not meaning you can't pay for a financial advisor, dude.
No
Like,
shot.
and a lot of people can't at that point. Like we don't have the money to, and then like it's gonna eat away at your returns. And if you don't have a big portfolio, it's like it might just not be reasonable, right? So like how can we apply this for someone? How can someone that isn't at the point that they can pay or get a financial advisor, how can they apply this rule?
Yeah, I mean, the first thing is if you don't have enough money for a financial advisor, generally you're probably not going to make that much money from investing anyways. But putting that aside, if the main benefit comes from emotional regulation from an advisor, the best thing to do would be to enlist the help of a trusted friend and or a few friends or maybe your parent or someone like that that can, you lay out why you're investing in certain stocks or certain things and then hold them accountable, like tell them what you're trying to do and why you need them to help keep your emotions in check and help them. Basically, when you're going to make a decision, you consult them and then they can help keep you in check with your emotions. I think that's a good way. Obviously, if they're a friend, they'll do it for free, hopefully.
Yeah,
If not, then tough.
and just make sure that the incentives for that friend, like if you are both in a position, right, it'll be you can say it's beneficial because both of y'all will have the incentive to want to act rationally there, but also at the same time there could be that incentive for your other friend to act irrationally because they're invested in it, and so they might not want to sell when maybe you're thinking about selling. So be aware, but again, I think just having someone that can help keep your behavior in check is the most important. But
Definitely.
now I think we stressed rule 2 enough.
Yeah.
You can't do this alone. But rule 3,
Trouble is opportunity. And this one actually, I think is very important. People miss this so much when we're in a just think about this logically. You hear this advice a lot. You buy low and you sell high, right? Because if you buy low, then you make money when the market goes up, and you sell high because it's already at its highest, so it can only go down. But a lot of times, what happens when we get into a bull market, which is when the market is going really great? A lot of people are like, "Oh wow, like the market's going up, it must keep going up, right?" And everyone starts buying and buying and buying, and then you have a crash, right? And then the people who got in at the very end, they lose a ton of money. And on the flip side, when we have that crash, everyone's like, "Oh no, the market's gone. Like I need to pull my money out like right now." That's actually the best time to put your money in, right? So
mm-hmm.
it's like it's this idea that when the market is at its best, it's going to reverse to the mean. And when the market is at its worst, it's also going to reverse to the mean, meaning it's going to reverse to the average. So when it's at its highest, it's actually its most risky. And when it's at its lowest, it's actually the least amount of risk. Okay. So trouble is opportunity. What that means is when the market is doing its worst, that is your opportunity to invest and make the most money when the market reverses back to the average and you get to capitalize on those gains.
And I think something added here just really quick is corrections and bear markets are common part of an investment lifetime. So like expect to see the market be in red a couple of times, maybe down 20%, down a lot sometimes. So he says, Dr. Crosby says, expect 10 to 12 bear markets in your life. And I think a bear market just means that we're at negative, or it's like 20% loss, around a
Yeah, just think of like a
20% loss.
recession.
And so corrects and bear markets are a long-term buying opportunity. So you cannot think long, you cannot think short-term when it comes to investing. And that's probably the biggest thing you're going to pull from this book, and hopefully you pull from us discussing these topics. So again, trouble is opportunity. And I think Warren Buffett has like a famous saying of like, when those be careful or be wary when people are greedy, and be greedy when people are fearful.
Yeah,
Or
something
so
along those
yeah,
lines.
it's be fearful when others are greedy, be greedy when others are fearful. So I
Right.
think that perfectly explains this.
And before we move on, just realize that this is hard advice to follow, not because it's difficult to understand, but because in the middle of a recession or a bear market, you're like, it's psychologically difficult to invest money in a market that is down, and it's psychologically difficult not to invest in a market that is up when everyone else is making money around you.
The way to
Um,
and then think one more thing to add, the way to think about this is when the market is down and you know like a good company, like if the market goes down but the company that you're interested in investing in has not changed from its principle, like what the business is doing or anything that's happened, it's at a discount. Think
yeah,
about
you're,
like
you're buying it at a discount.
you go on Black Friday shopping, it's at a discount. But so when it comes to the next rule, then this is just a hilarious quote. If you're excited, it's a bad idea. So rule number 4 is speaking directly about emotions here, and saying that when you become super excited about a certain investment, like some people with Tesla or me with Bitcoin or certain things like that, you tend to have your emotions start to take over your logical and sometimes your systems, right? And it's one of those things where it's very easy for you to become tied to something and get really excited when you hear the story behind the company, or you hear the idea that, Bitcoin is going to become the standard across the world. Like those narratives are really strong and they can persuade you. But one of those things to understand is that that's when you should be very careful. That's when you should start thinking like, okay, I need to poke holes at my thesis and find every reason why I might be wrong. Because in that time where you're just really high on that emotion, that is not the time that you want to buy. You want to be careful, reevaluate, think really hard, and understand that, am I excited because other people are telling me and I'm hearing this story and it sounds great? Or am I excited because I've heard the story, I've evaluated for myself, and I know it to be true from my own logical and own reasoning? So I think for rule number 4, pretty straightforward there. When it comes to rule number 5, this is just funny.
You are not special in a lot of ways. No, I'm just kidding. Maybe you're a little special, but in the world of investing, you're not special. Um, and so a lot of people think, okay, like everyone else, they follow these, like they're prone to these behavioral investing rules. Like, they invest when the markets are high, and they sell when the markets are low, and they make all these mistakes. But I don't make these mistakes. These mistakes, like I'm perfect,
Yeah.
like I got it. Just realize that we are all prone to the exact same fallacies and the exact same emotional dysregulation that disrupts our ability to make decisions in the market. And so, what you need to do is limit those, but you have to be upfront and honest by admitting that you do have those faults, because we all have them. And the best way to do that is use a rule-based approach to investing. And so, there's kind of two things that come to mind when we're thinking about uh, the common faults with people when people are investing. The first is fundamental attribution error. So all this simply means is that when you're investing, we have a tendency, really just in life, we have a tendency to attribute all of the good things to ourselves, right? And we have a tendency to attribute all of the bad things to everyone else or the market or environment, right? So we have a very incorrect view of what we've done correct or incorrect in the past, because we attribute things that are good to ourselves and things that are bad to others, or anything but ourselves, right? The second thing is that overconfidence bias, okay? And this is something where we overestimate our strengths and we underestimate our weaknesses. And this is really dangerous, specifically the weaknesses, because our risk comes from us underestimating our weaknesses, and that's where you lose a lot of money. And if you know Warren Buffett, he has two rules. The first is to never lose money, and the second is to always follow rule number 1, or something like that.
It's like never forget rule number 1.
Yeah, it's funny. It's like the rule that he has, the cardinal sin is losing money, right? And so if you're underestimating your weaknesses, that is the easiest way to lose money, because you're risking a lot of your assets by not realizing your weaknesses in investing.
And it's so easy for people to, think that way. Like the example about us always attributing good things to ourselves and putting the bad things to other people. It's like a group project. Like someone's like, "Oh, hey, oh, like when the project goes good, oh, I did this in the project. I did this part of the
Yeah,
project." You want to like make sure that everyone knows what you did, right? But when it goes bad, it's like we messed up. Like or
or
sometimes
they.
people throw the day and they're
I
like,
didn't
I'm
do that.
not responsible for
Yeah,
any of this. So really just having understanding that, but then two, knowing that there's so many smart people that go into finance because it's very lucrative and you can make a lot of money. I'm talking about people with their PhDs in financial engineering or maybe economics and all these different degrees, but they still struggle to beat the market. So if those people that are highly educated in the world of finance still cannot, I guess, outperform certain metrics, then you should not think that, oh, because you watch a couple YouTube videos or you read a couple books, you'll be able to do the same. So
or even if you made good returns on an investment that wasn't, like crypto. If you invested in a crypto coin, some altcoin that really isn't that safe, and you made a grand or two, that doesn't mean you're a good investor. That means you're a speculator and you got lucky. If you make a shot from half court, that doesn't mean the shot was a good shot. It just means you made the shot and you got lucky. So,
that is so true. That is
um,
so true. So don't get caught up in your own success
yeah,
and always humble yourself.
I feel like I beat that point enough just a second ago. Mel, what is the sixth rule
And
of
so
investing?
when it comes to investing, a lot of people like to compare how their returns did to a general index. So like there's this thing called the S&P 500, which is just like a stock that holds all the top 500 stocks, but it's really more like the top stocks just in the that are just the top stocks out there, right? I don't know if they're US based or it's like international, but the top
Yeah,
stocks doing really well. And so people will be like, "Oh, well, the S&P did 13%. I need to beat it by 15, right?" And a lot of people that are in the actual that work at Wall Street, this is how they think. But Dr. Crosby says this type of thinking is actually really, really bad because, especially for the retail investor, because why are you trying to be like, what do you gain from beating that, right? So he says rule number 6 is your life is the best benchmark, meaning that you should go with a goal-based approach to investing instead of saying, I need to beat this index or whatever. Because when you're following a goal-based approach, a goal-based investing approach, it helps you stick to your plan. Because when times are rough, you don't think, oh, well, when times are rough, the S&P or whatever index you're following may be doing bad. And so you think, okay, well, how can I do better than this? Or you start to freak out and say like, oh, this is what's happening. But when you're thinking about your goals, you go, well, I know I want to reach this amount by this age, blah, blah, blah. Then you take a step back and you understand that, okay, well, what's actually happening in the market? Like, where are the opportunities? So really the beauty of following, of using your life, of focusing on your own goals is that you have a clarity of mind when things go bad and you think long term. Again, stressing that investing should be long term. You are not going to get rich from investing. You don't create wealth from investing, you build wealth, meaning that you grow what you already have. So
exactly.
don't pay attention to short-term results. They are, after all, short terms. And just one thing I wanted to add too is that investing is a road towards financial freedom, and it's not about a game toward. It's not about anything else really. You should be worried about you reaching that freedom, whatever you define it to be. And that's my 2 cents.
I couldn't have said it better, so I'm not going to say anything.
Rule number 7.
Rule 7 is forecasting is for weathermen. What he goes into here is that a lot of people have started using models and these fancy indicators, and a lot of these, big data has pushed a lot of different ways to analyze the stock market and such. But he goes into the idea that these models don't actually give you much. The information that you get from fancy schmancy, data and information and all these weird stuff, they don't actually give you a whole lot. Remember that when you're investing in a company, what you're doing is you're just giving, you just own a small portion of a company, right? So you're just owning a small portion of Google or Apple or Walmart or whatever it is, right? So it doesn't matter what the models say. What matters is the fundamental company that lies behind your investment, right? And then he kind of moves into this other area um, of financial advisors. And so a lot of financial advisors, they will use models and all these other things to push their ideas of what they think is the best model as well, or the
Well,
best
I actually
investment.
want to say
Oh,
your
go ahead.
not to contradict, people get confused. Not financial advisors, but financial analysts.
Oh,
Those
okay.
that you read articles like, oh, this analyst from J.P. Morgan, this analyst from this place
Yeah.
is it's analysts because they're having to. You can explain the incentive models that they have, but it
Hmm.
works against you when you're reading these because they're obviously getting incentivized to write about a certain stock by a certain company sometimes.
Yeah, no, good clarification. The financial experts, a lot of the times these are people who are highly educated, have been in the school system, they have a PhD for whatever their specific area is, and they've been pretty much correct their entire life, and they come into the real world and they're wrong, and they don't think they're wrong because they're overconfident in their opinions, and they use these models to back their ideas up, but often these models aren't based that they're more of a correlation rather than a causation. Um, and so what Mel was talking about with financial advisors, though, is that
Analyst,
I think it's advisors actually.
it's analyst.
Well, because the advisors have, they make commissions on like your like how would analysts make money off you? They
He
get money off like you
what he
reading it.
was so what he was saying is that financial analysts
Hmm.
they have these reports, and whenever they're writing these reports sometimes they can't get access to certain information about a company unless that they
Mm,
agree with the company to be
he
like,
did say that, yeah.
hey, you should write a good thing for people to buy my stock because buying the stock would be good. So analysts, what you're doing when you're reading other people's interpretations of how of like the forecasting, because analysts, what they do is they predict where a stock is going based on like all this information they gather. But again, if they're the only way they can talk to a certain company is by agreeing to write good reviews, that can skew your perception, and if you base it off of that, it's going to be very hard. Now advisors, yes, there is trouble with advisors because you need to make sure that you're talking to a certain type of advisor, because there's advisors that make money off of certain things. I can't remember specifically what he said, but there's a question when if you go to rule number 2 in the book, if you look it up, he has some questions that you should ask, and the first question is, are you an advisor that what he says that practically works for me? Meaning, are you putting my interest ahead of everybody else? I just have to fight you on that because it's
No,
gonna
you're
get
right.
really
You're right. That was a
confusing
good.
on people
That was a
when
good
they hear like
clarification.
advisors and
Yeah,
all that. But yeah, so
and the point of all that was just to say that don't rely on models, don't rely on experts, don't rely on anyone except for yourself. Do your own research, understand what's happening in the background, understand the company you're investing in, why you're investing in them, and understand the foundation, what we call fundamental investing. Okay. Um, you can look up Warren Buffett. He's the one who really pushes this idea. But fundamental investing in the sense that you want to understand the fundamentals of the company, not all the data that surrounds them and the models and the weird predictions that you get from just inputting a bunch of data into
and the
math.
reason why that, because it can seem counterintuitive, like if these people get paid, like Armel, Ben, didn't you just say that you should talk to people that do this for a full-time job? Like, isn't that what financial analysts do? And one, we explained that their incentives could be against yours, and then but number two is the reason why you want to invest, you want to research yourself, it's going to help with your behavior. If you yourself understand fundamentally why you are investing in that company and not just like, oh, I heard this person say it's going to do well, you are less likely to make an irrational buy and a rational sell because you have your own thesis. You have reasoned through the investment purchase. So the reason why just reading an article and then going to buy that stock is not a good idea. It's not because you can do better research than those analysts. It's so that for your peace of mind that you understand why you are investing, and that's really like the biggest thing, because again, you can't predict the future, but you can come up with your own thesis to for you to believe that it's going to do well. Blah 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 blah. But enough on rule number 7. Rule number 8, and this one is like he really likes this quote. I think Dr. Crosby, he was like, "This is so facts. Many shall be restored that are now fallen, and many shall fall that are now in honor." So rule number 8 is excess is never permanent. Simply meaning that when things are going really well, it's probably going to come down. When things are really bad, it's probably going to go up. Pretty simple. But this idea, in a more in the term of psychology or whatever profession it is, it's regression towards mediocrity. Ben brought this up a bit earlier. It's just simply saying that like we tend to just go towards average. And he brought up a lot of great examples with sports. Like when someone has like a great game, they might the next day have a bad game, right? But this is just because like it's the rule of average. You're always going to come back to where you really are for like consistency, I guess, right? So if you're normally in the basketball sense, if you're average normally 20 points a game and you have a 40-point game, you shouldn't expect that person to keep having 40-point games. You probably there might have a 10-point game and it's all going to balance out, right? And so this is the same thing with the stock market, that stocks might be doing really, really well, but they might still have potential in the future. But there's things like we mentioned before, like corrections. And so you should expect a correction to happen. And you should expect that in the long term, you're going to understand the average. But in the short term, the excess, the excitement, or the bear market is not going to last forever. And a quote that he just loves saying is, "This too shall pass." So always think, this too shall pass. Everyone's super excited about crypto, blah, blah, blah. Crypto itself, the technology, is what you want to add, is not going to pass. But the speculation and the amount of money that people are throwing at it because they don't really understand yet is going to pass. And eventually you'll see the real winners. So
Right.
that is rule number 8. The rule number 9 is super uber important. And if you could break this down for us, Ben.
Yeah, there's a couple things to understand. The uber rich, so people like Elon, Warren Buffett, Mark Zuckerberg, the insane rich, a lot of times they are not very well diversified. And so rule number 9 is diversification means always having to say you're sorry. And he's advocating for diversification. But he points out that the uber rich aren't well diversified, but that's because the uber rich are on the same side of the coin of the uber poor, or on the opposite side of the coin of the uber poor, and that most people who are not well diversified are poor, right? And that only a small percentage, a small sliver of those who put all their eggs in one basket, if that basket goes crazy, if it goes, they win the lottery, they become super rich. And so the takeaway here is not necessarily that, that you shouldn't, it's not really about the rich and the poor. The real takeaway is this idea called variance strain. And so we often look for very high returns, and we're often looking for, we think that if we can get 100% return, that's really good. But it's not just about your return in 1 year. It's about your returns throughout your long-term investment. And so what variance strain is, well, I feel like you can explain this better, actually, because I know you really wanted to hit this topic.
Oh, yeah. So variance strain. So this straight up, just the definition that Dr. Crosby says is the determine. How do you say that word? I'm bad at pronouncing things.
Detrimental.
Yeah. The detrimental effect of compounding wealth off of lower lows when investing in a highly volatile manner, right? So like, what does this mean? What is lower lows? So essentially what he's saying is that if you are picking stocks or something that is like, if you're picking stocks are, I guess, volatile, right? And so 1 year the stock does really bad and it goes down like 20% or whatever, and it's valued less, but then the next year it goes up 40%, right? But in actuality, your long-term returns won't be as great as if you picked a stock that was consistent. And the reason why is because compound interest, the way it works is the amount of money you have in a return. So you have, let's say, $100. You invest something that has $100, and then it goes down to it goes down by 10%, right? So now you have $90. But then the next year it goes up by pick something simple, 10% again, right? Let's say it goes 10%, just because I don't want to do quick math on my head like that. But it goes up by 10%, right? And so now you're back up to what, $99, right? So, but if you pick a stock that was more not less volatile, you would have it, so it goes up by an average of like 10, right? It's just 10%. It goes up 10, so then you have $110 after that first year, but then the second year it compounds on 110. So what's important here is to understand, what are you compounding on? Like, you don't want to compound on lower numbers, even though the average return might be the same. You want to be compounding on higher numbers, if that makes sense. I hope I was able to explain that, but I think a good way to put it, to not stress this topic enough, is that it takes 100% gain to recoup from a 50% loss. So how I mentioned that if you lose 10%, but then you gain 10% again,
you lost money.
People think like, oh, wouldn't that even it out? No. You had 100, but then now you lost $10, but then you try to compound on 90. 90 is not 100, so you only get $9 back, and you've lost 1%.
Yeah, because you lost 10% of 100, but then you only gained 10% of 90, so you lost $1 there.
Simply well put. But you almost so we're talking about volatility, and it's like, okay, well, isn't that bad then? No.
Well, it's complicated.
It's a bit complicated. So rule number 10, the final rule is risk is not a squiggly line. Hilarious way to put it, but volatility is not risk, and I am so happy he had brought this up. Oh my.
It's such a crucial point because I took a finance class over the summer and they defined risk as volatility. So when he said this, I was like, yeah, that I'm glad they said this because in the class I was like, that doesn't really make sense to me. But my teacher didn't think I was right at all, so I just went with it. But keep going,
And
Mel.
the reason why a lot of traditional schools and finance people will say risk is volatility is because it's an easy way for them to calculate. It's an easy metric. People want to throw math and again fancy models and everything like that to it. But to think that risk is volatility is the same idea to think, and this was a great example from Nassim Taleb, and he says, so for anyone that doesn't understand volatility, that is like the price of something fluctuating a lot. So one day it might be up 10%, might be down 20, might be up 100, might be down 200, and all that. It's just fluctuating a lot. That amount of volatility, the 100, that's not good. You don't want that. But in general, you get the idea. So what he says with volatility is that, so imagine that someone that's working, like a husband or whatever, he comes back home at 6 o'clock precisely, right? So this is related to a stock that is not volatile, that is pretty consistent. So the stock goes up, let's say it doesn't swing a lot, it has a natural growth of like 2% or whatever, 5%, right? But compare that to a husband that comes back around 6 o'clock, so maybe 5:30, 6:30, right? But when there's a change in the stock that is constant, like when that husband coming back at 6 o'clock just doesn't come back at that exact time. Maybe he comes a little like 5 minutes late, 10 minutes late, something, not a lot of time difference, but it makes you worry, right? And so the idea with the stock is when you have something that's not volatile, you tend to immediately get emotional, immediately make irrational decisions when you see a change because you're like, oh, well, like what's happening? Like, da da da. But then when it comes to a volatile stock or something that is, let's say by definition, less volatile, you more volatile. Like if the husband comes back at like 6:05, he comes back at 6:20, or he comes early at like 5:20. That is to be expected. You've already ingrained that idea, like that is to be expected. But this has more to do with different asset classes, right? So when I'm talking about the less volatile, I'm talking about something like what he calls like bonds and different type of like bonds. What bonds are like government debt. So they're saying like, hey, this is debt. We'll pay you back a set interest rate, right? And that's less volatile. But the reason why he talks about volatility is saying like if you just should decide like, hey, I want the less volatile thing, you're what you're doing is you're having a trade-off saying, okay, you want less volatility, you're going to get less returns overall, right? And so the idea is that the stock market is just more volatile than a lot of other asset classes because you can find things like bonds, again, gold, where you're not really getting much appreciation, but the price of it staying constant. But again, we're trying to beat inflation. This is the idea that the reason why you invest is you're trying to beat inflation. So you take the risk of, or perceived risk of doing the stock market, it's more volatile. But the thing is, again, thinking long term, you understand that volatility averages out to about a 7% return after you account for inflation and things like that. So again, simply put, volatility is not risk. The real risk comes from understanding the company. So if something in the company changes, that's what's important. Looking at the price of an asset is not going to tell you the important information. That is not how you should assess a company. And specifically understanding that when you're investing in a company, you're investing in a company. You own a part of that company. So you should be worried about what the company's doing and not what people are thinking the company's going to do, because that price itself is just a reflection of people's speculation or people's theories. But what the company's actually doing is the foundation to why people are investing in it. So again, just understanding that is super important. And I wanted to tie this into Bitcoin. You guys should have seen this coming. Bitcoin is volatile. Yes. Duh. What has it been doing? Appreciating up in the long term, right? But to give a better argument for it is to say that if you understand that Bitcoin is not an investment, Bitcoin is more of gold. Bitcoin is not in itself. It's a different asset class in itself, meaning that I want to pick my words carefully here. because I don't want to have people wanting to just go off and invest in Bitcoin, do your own research. But if you understand like the differences of why people invest in Bitcoin, that it's not just a speculation, and that you understand that the volatility is a result of the technology being new, and you think long term, and you believe, and if you believe that Bitcoin will be the standard, that governments, people will save in Bitcoin, will use that as money because it cannot be violated, it cannot be inflated away, then you understand that the volatility in Bitcoin is not a risk. And if you're only looking at the volatility of Bitcoin, you're giving up on the upside of what it could be in the future. So again, invest in things because you understand, but don't look at the price as a metric for you to decide whether you want to invest. That was a long rant.
Real quick, just another way to look at this is if a stock is steadily trending downward, but very steadily, because it's steady, we would define, people would define the risk as being low, right? But if it's trending downwards, it's a risky stock because it's not like let's say Blockbuster back in the, before Netflix came along.
Mm-hmm.
It was very, if it has a very low volatility where it's going at the same pace, but it's trending downward, and Netflix is taking over. Its risk is not in its lack of volatility. Its risk is in the fact that the company is about to go bankrupt from Netflix, right? And in the same vein, if a company is highly volatile, but over a course of 5 or 10 years, its growth is very high despite its volatility, the 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 risk is not in the volatility of the asset. The risk is in the value of the company. In this case, because the company is sound, even though it's volatile, it's a low risk because it's a good company underlying the stock. Okay.
That's a great example. The risk is in the incompetency of the company. So I just wanted to use that word. But with all that being said, knowledge isn't enough to succeed in investing. This is a direct quote from Dr. Crosby. You must use a strategy and set up a system to control your emotions and allow you to use your knowledge effectively. So this is what we'll talk about more in the second part of the Laws of Wealth summary. But with all that being said, we've come to the end. We've covered a lot of topics, but you don't really need to understand the minute details. I mean, you should, right? If you've listened to this whole thing, you have. But I guess just understanding the rules will be a good way. So if you could recap everything we've talked about, Ben.
That's a big task, but I got you. Okay, I'm gonna go through the 10 rules. Number 1, you control what matters most, so you control your emotions. Number 2, you cannot do this alone. Get a friend, a financial advisor, someone to regulate your emotions. Number 3, trouble is opportunity. In a bear market, that is opportunity. Number 4, if you're excited by some narrative or whatever it is, it's probably a bad idea. Number 5, you're not special. You can't control your emotions any better than anyone else. Use a rule-based approach. Number 6, your life is the best benchmark. Use goals that are good for you, not the S&P 500. Number 7, forecasting is for weathermen, okay? Don't trust the models. Don't trust anyone else. Do your own research. Number 8, excess is never permanent. When the market is at its highest, that's when it's at its most risky. It's going to reverse to the mean. Number 9, diversification means having to always say you're sorry. Diversification reduces variance strain and helps you get better returns over the long term. Number 10, risk is not volatility, okay? Risk is the underlying asset that you're invested in. I hope that makes sense. Thank you, guys. Now it's time for my favorite part of the episode, a quote from Amelicus Melius.
If investing is entertaining, if you're having fun, you're probably not making any money. Good investing is boring. George Soros. So, I mean, that is truth, y'all.
He's spitting facts.
That is truth. Investing is one of those things that people will sell you on this, like, oh, look at me trading day stocks, blah, 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 day trading. Oh, look at this lavish life I got from, investing. Like, again, when you're investing, you are building wealth. You're buying assets that make money while you sleep. Not because they make a lot of money, but because they make money that will compound. And in the long term, that is where real wealth is built. So understanding that will give you a perspective that investing shouldn't be this interesting stuff. You should really not even be looking at your account that often. You should pick a strategy, pick the stocks you believe in, think long term, and you will build wealth that way. So with all that being said, that is a great way to conclude. Anything else you want to add, Ben?
Nope.
Nope. So with that being said, we try to keep this under 30 minutes, but we can't resist to give you guys all the knowledge. Have to. So, but thank you guys for listening. It's been an honor. Make sure you guys like, subscribe. I really got to start saying this at the beginning Jeez. But make sure you like, subscribe, share with your friends, share with those who need to know. Your parents might need to hear this information. They're coming closer to retirement,
It's
and
great to recap.
investing is good for everybody, especially when you start young. So check out the clothing brand, check out the blogs, more good stuff coming out. And with all that being said, till next time, peace.